this. Now, I want us to talk about accounting for assets, and this is contained in International Accounting Standards 16, number 16. That is property, plant, and equipment. And I know I have notes here, and I'm going to share this, but I don't want your focus to be so much on what is shared. I don't want your focus to be so much on what I'm sharing here. Because I always have a challenge. I share something like this. Some of you want to write notes, and I don't want you to write notes, because you write notes, you lose. I will lose you along the way. Try to write notes, you get lost. I am positive about that. So it is more important for you to listen to what I'm saying rather than to write the notes. Notes will come in later, right? Notes can come in later. For now, listen. You listen to what I have to. You listen to what I have to say. And once you are able to know what I'm saying, then it will be good with you, right? And therefore, this is simply what I mean. We said that we are supposed to, at the end of every year, we are supposed to report, to do our financials, or to do the financial statement for a business. And if you're keen in the balance sheet, one of the things that is key is what we call fixed assets, right? And fixed assets will consist things like plant and machinery. We have equipment, right? We have vehicles, all those, and you have to list them. I think we list them first before we list any other item, non-current assets, right? But you can imagine, look at a scenario where we buy a tractor, or we bought a tractor, let's say in 2018, at 20 million, right? Assuming we bought a tractor in 2018 at 20 million. We used it in 2018, we are using it in 2019. When we'll be reporting it this year, for us to be prudent, and remember about the prudence, one of the principles of accounting, prudence. We don't want to overstate. We don't want to overstate profit. For example, we want to be prudent. We want to be conservative in our reporting, right? We don't want to overstate the profit. And therefore, if we put in that figure as 20 million now, yet we have used that tractor for 2 years, it will not be fair, because that vehicle has generated profit, right, for us. At the same time, it has had what we call wear and tear. It has what we call wear and tear, which means it is reducing in value as time goes by. It is reducing in value as the time goes by. I want to hope that is making sense. And therefore, it would be important for us to calculate what we call depreciation, right? It will be important for us to calculate what we call depreciation, so that that depreciation is taken to the profit and loss account, right? And then in the balance sheet, we reduce that balance of the vehicle with the depreciation for that year. And I know we have done this before. We have done this, the concept of depreciation, we have talked about it before. It's only now that we want to focus on it and consider it. Now, depreciation is what we call systematic allocation of depreciable amount of an asset over its useful life. And we talk about useful life here because sometimes the vehicle or the item or the property can have a useful life of, let's say, 10 years, but at the end of the 10 years, you can still sell that scrap or whatever is remaining of that vehicle and get some money, right? Or realize some value, whether you sell it as a whole or whether you sell scrap, you break it into parts and sell it. And those small, that value that you get at the end of the useful life a useful life of a property is what we call residue or residual value. Residual value is I have highlighted here. I hope you are able to see it. That is what we call residual value. It is the value that you get of the remaining or the remains of an asset when you dispose it at the end of its useful life, right? At the end of its useful life. Now, depreciation is what we call diminution, right? Or reduction in value. Depreciation is simply reduction in value of an asset due to what we call wear and tear, because of wearing, because of tearing, or sometimes because of just the passage of time. The fact that the vehicle that the bus that was bought 3 years ago would not cost the same today. Whether it is still roadworthy or not roadworthy, it will not cost the same today. And again, I also know if you buy a Range Rover today for 11, 12 million at Titidobi, right? Once you take it out of that place, you cannot sell it for the same amount. True or false? Because it is assumed that there is a reduction in value as long as it has started moving. I know we know that. And therefore, what we are saying here is that the true profit of a business cannot be ascertained unless depreciation has been allowed for. Very, very important to note this, that you cannot ascertain the true profit of a business until and unless you factor in what we call depreciation. Because remember, in the balance sheet, you are putting in assets. You need to get the real value of those assets. In as much as there's a column for listing the actual cost, you need to get the actual value of that asset, and you can only get it by subtracting what? Depreciation. And therefore, depreciation means a fall in quality or simply a fall in value of an asset. A fall in value of an asset. A fall in value of an asset. And the factors that may cause depreciation, one is what we call wear and tear. That is due to actual use. You are using it, it is wearing out, right? Then we also have what we call efflux of time or passage of time. Passage of time. Passage of time. Number three, we have what we call obsolescence. We have obsolescence, or becomes obsolete or useless. You cannot use it. Imepitwa na wakati, right? New technology has come in, and you'd want to, use the new technology. So even if you had a certain machine, it might no longer be useful. We say that it is obsolete. So obsolescence. We also have what we call accidents. Sometimes accidents occur, and as a result, the value of that asset is reduced. And sometimes you may also have what we call fall in market prices. You bought it at 12 million, technology has changed. Right now you can buy the same equipment, the same quality at 5 million, right? And therefore, again, you factor in what we call depreciation. Now, the fact to remember is that except for a few cases, like the issues of land, all other assets will depreciate, right? Apart from few cases where we may have issue of land, it may be old paintings, the one that keeps on increasing in value, it may be mine, where we are mining minerals, we have discovered that we have a bigger layer, and the value of that is increasing, except for those very few cases. Then most of the fixed asset actually depreciate. They reduce in value over time, right? They reduce in value over time. And therefore, it is important for us to get these basic factors when we're talking about depreciation. And one is the cost of the asset. This is the value at which it was bought. This is the purchase price. The actual cost becomes the purchase price. That is the value or the price at which we bought an equipment. Good. Number two, we have what we call estimated residual or scrap value. It can either be called residual value or what? Or scrap value. Residual, estimated residual value, or you can also call it what? Scrap value at the end of its life, right? And therefore, we also have what we call estimated number of years of its life. Every asset has its own life. Just the way you as a person have a number of years that you will live. Yeah. And when you talk about the estimated years of life, we are talking about the estimated number of years that that asset is going to be in use and the time within which it will be generating income for us, right? For example, there are some machines that can run for 50 years. Others can only run for 10 years. Others can only run for 2 years. A good example, look at your phone, whatever model you're using. Within, even if you bought it today, within a few years' time, you cannot sell it for the same, exactly the same amount that you bought it. Today, you might have bought it at 10 or 20,000. Tomorrow, if you want to sell it, you cannot fetch the same price unless you find a danda, you know, wale watu, how do I explain this? They are nishika. Watu hawashiki maneno, hawaelewi, right? The ones you can simply con, right? And they will be able to give you the same amount or even a higher amount. Unasema umewagonga, right? But in a normal sense, it will be very difficult for you to do what? To sell it and fetch the same amount of money that you paid. Now, that phone of yours, even if it does not spoil, even if that phone does not spoil, it might not stay for 10 years, right? It might be 2 to 3 years. Then you might be forced to change. Now, that 2 to 3 years is what we are calling, that is what we are calling what? Estimated years or estimated life of your phone, right? Some of your phones I know come from China. Give it 2 years and it is done. You have to look for another one. Others come from different other companies and they might last for 5 years. Like Samsung, I know is good, can last for 5, sometimes 10 years, right? And then you'll have to change it. And no, I like to keep on looking at what you people are saying here. So, oh, iPhone. So what is the, what, 50 years for iPhone? No, no, iPhone is 2 months. Ombui, I hear you. I hear you. Ombui is saying 2 months, somebody is saying 50 years. A phone cannot last 50 years. And even if it lasts for 50 years, itakuwa imepitwa na wakati. New technology will have come in that will make it obsolete. Yeah, it will make it obsolete. It will make it obsolete. And therefore, those are very important values that we need to look at. So what are the objectives of providing for depreciation? Why do we provide for depreciation? One is to ascertain the true value of an asset and the financial position. Because now if you value in your asset, if you have several vehicles, if you have Land Cruiser that you bought at 6 million in 2015, if you still value it at, if we ask you how much you are worth today, would you still tell us 15 million? Just because that is the price, no, 6 million, just because that is the price that you paid for it those days? Of course, no. You need to be realistic. You need to be realistic, and therefore you might want to value that vehicle and then tell us probably today it is worth 3 million, right? And therefore, to ascertain the true value of an asset, then we must provide for depreciation. Number two is to make provision for replacement of worn out assets, right? To make provision for replacement of worn out assets. And this is very simple. If you have a machine that costs you 100 million today, would you want to use that machine, right, without setting some profit aside or some, that is what you call provision. You're putting some money aside so that if that machine wears down by 2030, you will have enough money that you have set aside to buy a new machine, right? Because that is what we are calling the provision for replacement. That as I use this machine, which is very expensive, it is generating money for me. And out of the money that it generates for me, which is the profit, I would be setting some amount aside so that I accumulate this money. By the time this machine is failing to work in year 2030, I will have sufficient amount, or I will have some good amount that I can add little amount on top of it and buy a new machine. That is what we call provision. And therefore, providing for depreciation helps us. It will help the business, helps the business to do what? To be able to replace that asset when that time comes. Number 3 is to calculate the correct amount of profit or loss. If you do not provide for depreciation, you will get an overstated figure of profit or loss. Simply because you're failing to recognize that this machine is contributing towards the profit of the business. And just like the labor that you pay, just like the electricity that you pay, this machine is being used. So how much do you pay it? How much do you pay it? Now, the amount that you'd allocate to it is what you're calling what? Depreciation. Otherwise, if you don't factor that in, you will have overstated your profit or loss. We have also computed the cost of production. Yeah, the machine is being used, and therefore it is contributing towards the goods that you produce at the end of the day. If you are using a bakery machine to bake, no, you don't just count the cost of wheat, the cost of milk, and what else is used? The cost of water, right? And sugar. You also need to factor in what amount can I allocate out of the machine? What amount can I allocate as a cost into the production of this bread? And therefore, you need to factor that in. Number 5, of course, to comply with the legal provision, because Section 205 of the Companies Act provides that depreciation on asset is necessary and therefore must be accounted for. Therefore, you must do that. Number 6 is to avail tax benefit. Because simply because if you overstate your profit, because we have said if you don't charge depreciation, you will overstate your profit. If you overstate your profit, then it means that you will pay more tax. You will pay more tax because you can assume, let me try to demonstrate here. Let's assume that the profit that the business, this is profit before you subtract depreciation, right? If you say that profit is 6 million, for example, you know tax is paid on profit. And therefore, if tax is 20%, this means that you will pay a tax of 1.2, right? If it is 20%, then it means tax will be 1.2, right? But if you are able to less depreciation, let's say depreciation is let's say 1 million, right? If depreciation is 1 million, right? Then you will have what you call profit after depreciation, of how much? 5 million, right? And therefore tax that you will pay on this will be 20%, which is what? Which becomes what? Which becomes 1 million. And therefore, as you can see, you've been able to reduce your profit by 200,000 because it has reduced from 1.2 that you'd have paid if you had 6 million profit to 1 million that you would pay after deducting what? Depreciation, right? I hope that example is clear. I was explaining this point that it will avail some tax benefit. You will benefit for the tax purposes after you are able to deduct that. Is it clear up to that point? Is it clear up to that point? Is everything clear? What is not clear? Can you ask a specific question? You cannot tell me pardon, sir. What do I explain? Ask specific questions. Ask a specific question. No, I've just explained this. Do I need to repeat this? My good people, I've said if you calculate profit, yeah, because what usually happen, even when you look at what we do, we get gross profit, right? When we get the gross profit, this is usually before what? Before we are able to subtract what? Depreciation, right? Now I'm saying assume you've gotten a gross profit of 6 million, right? You've gotten a gross profit of 6 million. Then what do you do next? You less expenses, right? You less what? Expenses. And among the expenses is what we call what? Depreciation, right? In your expenses, depreciation is always there, right? And therefore, assuming that this is the only expense that you have here for the purposes of working out, and you assume that depreciation here, the total expenses is 1 million, right? It means that profit, it will mean that net profit will be 5 million. I hope we are together up to that point. It means that the net profit will be 5 million. Now, when people are paying tax, you'll be told that tax probably is charged at a certain percentage. Let's say 20%. 20% of the profit that you make. So 20% of this becomes what? 20% of the profit that you made becomes what? 1 million. True or false? True or false? True, right? So you can imagine if you decide not to charge this depreciation, if you decide not to charge that depreciation, what does it mean? That the profit, gross profit was 6 million, right? On the expenses side, you have 0, right? And then net profit becomes 6 million, and the tax would be 20 of that. That is 1.2 million, right? Tax becomes 1.2 million. And this you are paying it to the government, which means if you charge depreciation the way you have charged it in the first column, you end up paying less to the government in form of taxes. But if you do not charge that depreciation, then you end up paying more to the government in form of tax. That is why I'm saying it is a benefit to you if you charge depreciation. It is a benefit to you if you charge depreciation. I hope that is clear. I hope that that is clear. Yes, it is clear now. Good, good. I always tell you, you are smart. You're smart people, eh? Don't let anybody else cheat you. Hata masomo yakikukalia ngumu, you're not getting computer. You're not getting what? You know, you're not getting these funny courses. Tell them to come to accounting. And they see how you do it here, right? Understanding the concepts very fast. Now, I want us to briefly look at the methods of providing for depreciation, depreciation. And you will excuse me, I may not be able to go through all these methods, right? And therefore, I want to hope that you will have an idea. And I think for the coverage of this lesson, I think I would rather concentrate with the two, right? Or I end up confusing you. I don't want to end up confusing you people. Now, we have many methods of depreciating an asset. And remember, depreciating an asset, what we are looking for is what value must we reduce this value of this asset with for us to reflect what we call prudence in our reporting. There are two main methods. Which is fixed percentage method, also called straight line method. And you know, in exam, you always be told whether it is a straight line or whether it is the reducing balance. These are the most commonly used terms that you told assume in the information, additional information, assume a straight line depreciation method, assume a reducing balance depreciation method. And therefore, even as I try to look at these others, I will put a lot of emphasis on these two, because at this level, these are the ones that are very, very, very important, right? These are the ones that are very, very important for us. Good, so we start with the fixed. We start with the fixed percentage on original cost. We have also called this straight line method. And I hope you have a pen and a paper. We have also called the straight line method of depreciation. Straight line method of depreciation. Straight line method of depreciation. Very, very important. You'll be finding this in many years to come, right? Now, I want to be very simple. I want to be very brief on this so that it is well understood. I want to be very simple and very straight on this so that we are able to understand. Now, assume now under this method, the suitable percentage of original cost is written off every year, right? Therefore, if an asset cost, tell me that you're still able to hear me. I've had my computer make some noise. I'm not sure whether you're able to hear me. Kindly confirm. Someone confirm if you're able to hear me. Good, can proceed. Now, this is it. If you assume an asset cost you 20,000, and then you've been given 10% depreciation, or for that asset, you find out that 10% depreciation will be proper for that asset. What that means is that every year, let's say year one, depreciation will be 10% of what? 10% of 20,000, which is 2,000, right? Year two, depreciation will be again 10% of 20,000, right? Which will give us what? Which will give us, see this, which will give us another 2,000, right? Year three, year four, year five, year six, 2,000, 2,000, until that amount there is over. Until that amount there is over. until that amount there is over. So this is a straight line. You apply the same percentage throughout the period. So which means that the value of that asset will be reducing by 2,000 every year. And therefore, you'll have something like this in your balance sheet. You'll have something like this. One is the asset at cost. It's working. Asset at cost. Then you'll have what? Depreciation. And then you'll have what we call what? Net book value, if you remember. So for year one, the cost here, we have said already is 20,000. The value of depreciation per year we've counted to be 2,000. And therefore, the net book value will be 20,000 minus 2,000. It will be 18,000, right? I hope you are following. Year two, we will start with the cost of the asset, right? At that time, we may still call it 18,000, right? Or alternatively, sorry, let me do this in a proper way. The cost, this is the price at which we bought it, will not change, right? The value of depreciation will be 2,000 for that year, which is 10% of the 20,000. And the value here at the end will be 16,000. Can you see that? Because now we have 2,000 for year one and 2,000 for year two, right? Year three, say the value, the actual cost, the price at which we bought it was 20,000. The value for depreciation, 10%, right? What will be the value? What would be the value? You can give me that value if you're following me. What will be the value there? 14,000. Very true. 14,000. Now, this method is what you're calling the reducing balance. That method is what we are calling the reducing balance. I hope that is clear. I hope that is clear. Is it? Is that explanation clear? Is that explanation clear? I'm waiting for a comment there. Yes, no, yes, then I proceed. Thank you, thank you. Good. Now, another concept here. If you look at this point, you've been given the amount at which it costed and a percentage, right? The amount and a percentage. Sometimes that amount and percentage is not given, right? You might be told that the cost, and I want you now to get this correctly, that the cost is 20,000, right? The cost is 20,000. And then you are told that the scrap value or the residual, let me use residual value is, let's say, 2,000. No, let me use a different figure. Residual value is 4,000. That is the cost at the end of the useful life of this instrument. And then you've been told that this instrument has an estimated life. It has an estimated life of 8 years. 8 years, right? If this is the information that you have and you've not been given the percentage, then depreciation will be calculated as what is here. Depreciation becomes the cost minus the estimated. Let me put it this. Let me cut that and put it here. Depreciation becomes cost is equals to cost minus the estimated scrap value, right? For you to know the depreciation per year, then you divide all that by the number of years. Number of the estimated life, right? So this one can be that way. So in our case, if this is the scenario, it therefore becomes where is this? Good. And therefore, what that means is that depreciation becomes what? Is equals to cost, which is 20,000, minus scrap value, which is 4,000, right? Divided by the number of years is 8, right? So depreciation per year becomes what? Depreciation per year becomes what? Good people. It becomes what? 2,000. Do you see that? Are you able to follow that? The depreciation, given the percentage and also given these other figures we are looking at here, the depreciation becomes cost of the asset minus estimated scrap or residual value divided by the number of years that the useful life of that asset. And therefore, for every year, you'll be reducing it by 2,000. So the flow year, because the depreciation is the same, will remain the same. These figures for this will remain the same because the value of depreciation is the same. I want to ensure that that is clear before I explain the second concept of depreciation. Is it clear? Is it clear? Is it clear? Need a confirmation from you, my people. Very nice, very nice. I'm encouraged by what I'm seeing here. Very good. Clear, clear. Yes, clear. Nice. Very nice. Good. Now, that is what we call straight line depreciation or fixed percentage on original cost. Simply refer to it as straight line. The second method is what we call reducing balance. The second method is what we call reducing balance. Let me put this there. The second method is what we call reducing balance. Under this method, the rate or the percentage of depreciation is fixed, right? But it only applies to the value at which the asset stands in the beginning of every year. It applies to the value at which that asset stands at the beginning of every year. So that if we have something like this, if we have the same example here, right? Let me copy this. Allow me to put it here so that we can do the workings with you, right? Allow me to put it there. If an asset costs 20 and 10% depreciation, assuming what? Assuming a reducing balance. Balance method of depreciation workings will be as follows, right? You're my people, you're my guys, Watunguyas. So I must be able to look at this. Remember, this is the way it is. Let me copy this. This is what is important. This is what will be very, very, very important. Very, very important. Very, very important. Now, if you're keen, let me remove some of these things, right? So that we start at Where do we start? At 20. The value of our asset here is how much? It is 20. Year one, the value is 20. So the depreciation for that year will be 10% of the 20,000, which will be 2,000. I hope we agree up to that point. But the net book value becomes 18,000, right? Under the reducing balance method, it is this balance now that starts in the second year. That will be our balance, beginning balance, right? Then from there, we charge 10% of that, which will become what? 1,800, right? And therefore, the new book value will be 18,000 minus 1,800, which should be 16,200 if I am not wrong, right? That 16,200 becomes our value, beginning value for the third year, 16,200, right? And the balance, the depreciation for that year is 10% of that, which is someone to give us very fast, very fast, very fast. I want to see whether you're following. Good, very good, Malanga. 1620. So what will be the net book value? Someone, net book value? Net book value? Net book value, someone? To give us 14,580. Very good. 14,580. And therefore, in year 4, that becomes our what? What becomes our balance here? The cost of the asset there, what will it give us? What will be the cost there? 14,580. 14,580. What will be the depreciation? 14,58. You're right. 14,58. What will be our net book value? What will be our net book value? 13,122. Do I need to go on? No. You already gotten the concept. Here, we are using this balance at the end of the year as our balance at the beginning of the next year, right? And if you look at this, then you'll notice that this value of depreciation is not constant, right? It is not constant. It keeps on reducing. The other one, the balance is constant. For all those here, year 4, if you want to find year 4, you can still find that. It will be 20,000 there. Then the next one will be 2,000. Then the next one there will be 12,000. And that process repeats. Depreciation remains the same. That's why it is also called fixed percentage or straight line method. And this other one, these things keep on changing. That's why we are calling it what? Reducing what? Balance. The depreciation is charged on the reducing balance of an asset. Is that clear, good people? Confirm whether that is clear. Confirm whether that is clear. You people are brighter than I thought. Seem brighter than I thought. I thought it would be very difficult to understand these things. Clear kabisa. Now, you allow me not to mention about these other methods, right? This is not the right time. They are in the notes. If you need, you can look at them. In case you find a question that is using a different method, you can look at these methods. But I'm very sure you'll be covering these methods later in a unit we call accounting for assets, right? Here, our focus was on depreciation alone. And if need be, I can still remove all Yes, some people can't hear me. Oh my. What's up? Nitarudia. Ah, are you able to hear me? Good people, can you hear me? I am good now. Ah, I have to shout. Good. We proceed then. We proceed. We proceed. There are people white again. You can't hear me. Yeah? Hii sauti inarudi. Imekuja. Kwenu, probably kwenu ni mbali. Ingine kwenu ni mbali. It must travel all those kilometers to where you are. Yeah? Thank you. Thank you. Thank you. No, I was not talking to myself. I was talking to you. Kadaya. Eh? Hey, Mora. That's from here, from Ruiru to Kisii. It's a long, long, long journey. Kilometers. Eh? It has to take a lot of time traveling for the land and the sea and the air up to Kisii. Tunaona tu kasa ikimove. You just landed. So we can. There's a good break. It's a good break, right? We can proceed. Look at the question that you have. Look at the question that you have. There's nothing much. There's nothing much I've said, Duncan. Nothing much. You cannot miss out on what we've already done. Now look at the question that you have. I was talking about the question that I know some of you printed it, some of you wrote it in your notebooks, and some of you decided not even to write or even print it. Yeah? They have it offhand, right? Yeah? Which is okay. It's okay. We are different, but it is okay the way you are. You're okay. Just the way you are. Don't tell them you're not okay. You are good, right? You're good. Just the way you are. Eh? Don't need to change anything. Created beautiful and smart upstairs. Yeah. Good. So we can proceed. We can proceed, right? Can proceed. Now, if you have this question, what is important to note? The time at which we buy an equipment is very, very important. The time at which we sell that equipment is very, very important. The time at which the estimated life of that equipment is very, very important. This is because in normal situation, depreciation is given as a percentage per annum, right? Per annum, or PA, means per year. Every year, right? Per year. Now, what is important for us to note here? What is very important for us to note here? That if you bought a machine costing 20,000 in January 1st, 2019, right? If you bought it January 1st, 2019, costing 20,000, right? And the depreciation rate is 10%, then we'll charge a depreciation of 2,000 per year, right? But if we bought the same machine, 20,000, right? Let me put this into perspective. We bought it on July 1st, July 1st, 2019. Though the depreciation still is 10%, this machine was bought on July 1st, right? Which means we must be able to calculate from July 1st to December 31st. And because per year it is 2,000, right? Depreciation, right? It means for these 6 months, it should be 2,000 multiplied by 6 months over 12, which is half an year. Half an year. Is that clear? Very, very clear concept. You must be able to subdivide depreciation, in case it is given per year or per annum, you must be able to know for how much depreciation will you allocate for a specific term. Sometimes 6 months, sometimes it may be 3 months, sometimes it may be 9 months, sometimes it may be 10 months. It is you to calculate that. It is you to calculate that. That's just a reminder here. Otherwise, the question still remains that way. Now, if that is the question the way it is there, let me see. Let me see this so that we know where we are. Let me get an Excel so that we do these things together. We want to do them together. I'm not sure how to share this Excel. I am not sure how to share this. Who knows how to share Excels? Who knows? Who knows? I want us to proceed together. So allow me just in a moment. My friend, who is this making a lot of noise here? And why is he making a lot of noise? I want us to share this. Let me share this. Allow me to share this. Can stop the share. The other one, so that I share the new Excel. Very good. Are you able to see that? Are you able to see that? Are you able to see that? One confirm. Someone confirm. Yes, 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 yes. Thank you. Thank you. Now, if you look at that question that I've given there, we've been told to prepare one, plant or equipment account. Number two, we prepare provision for depreciation. And number three, we are supposed to extract and show how a balance sheet would look like, right? And therefore, here I've started with what we call plant. I've started with what we call plant account. Then here down, I have provision for depreciation. And lastly, I will have a balance sheet extract there, right? Now, look at the question. What is the first statement that you've been told there? When the machinery was bought, 1999, 1st January, we bought one machine, one plant costing 8,000. And therefore, we need to record that. We will need to record that. How do we record that? How do we record that? Are you seeing? Oh my, what happened here? So 1st January 1999, we bought a machine from the cash book, right? Or with cash, or whatever, with its bank column, it's okay. But we bought it at how much? Someone very fast. Very fast. Someone tell us, at what amount did you buy the machine? 8,000. And therefore, in our account, remember, this is an asset. So we debit 8,000, right? We debit it with 8,000. We debit it with 8,000. For the whole of 99, is there any other transaction that has happened in this question? Can you confirm? Is there anything that has happened in 1999 within that year? Is there anything that has happened? No. Good. And therefore, our balance carried down on 31st December 1999 will be 8,000, right? You agree with me? It will be 8,000, right? It will be 8,000. It will be 8,000. Now, what do you think will be our depreciation for that year? What will be our depreciation for that year? What will be our depreciation for that year? I need an answer. I say depreciation, we have always done these things. What will be our depreciation? The depreciation rate is already given there per annum. It is 800. Can you see that? Can you see that? It is 800. And therefore, that amount must enter into what we call the provision for depreciation account, right? And here, therefore, in this provision, we must write 800 and take it to the P and L, right? We take that amount to profit and loss, 800 there. And this is at 31st December 1999. And therefore, we expect that the balance carried down here at the end of that year will be 800, right? Are we able to see that? That will be the balance carried down. And therefore, this balance that we have carried down here must be taken to be balance brought down on 1st January year 2000. Do you see that? Do you see that? That 800 will be your balance that year. And for the plant account, the balance of our equipment, this balance here carried down will be our opening balance here, 8,000. We close this like a complete transaction, and this one is closed like a complete transaction. I want to know whether it is making sense. Good, it is. Now, let's continue and look at what happened the other year. What is it that happened in year 2000? What happened in year 2000? What happened in year 2000? We bought a machine, we bought another plant. Actually, not just one. 1st July, yeah, 1st July, we bought what? So here we record 1st 07 year 2000. We bought a machine. We bought 2 plants costing 5,000 each. And therefore, this one should give us a total of what? 10,000. Do you see that? Do we see that? A total of 10,000. Then there is another additional machine that we bought on October 1st. October 1st, we bought another machine. So 1st October 20 year 2000. And I told you dates are very important. So here we have bought another machine costing 6,000. We have bought another machine costing 6,000. Is there any other machine that we have bought that year? Any other machine that we have bought that year? Kindly confirm. There is no other machine, right? There is no other machine that we have bought that year. And therefore, we have the original machine here that we bought in 1999. Then we have a cash book here, machine that we have bought July. And then we have what we call a machine that we have bought in October, right? And therefore, we will need to calculate those depreciations. We will need to calculate those depreciation, right? We need to calculate those depreciation so that we know what is it that will be put here, what is it that will be put there. And therefore, if you're keen, if we have these figures here, let me just copy this for clarity purposes. If we have those figures there, what will be the depreciation of this machine, the first one? What will be the depreciation of this first machine? And I'm not sure whether we said we are assuming a straight line. Eh? Was it in the question? Was straight line method in the question? If it was not, assume we are using straight line method. We assume we are using straight line method. So what will be the depreciation of this first machine? Someone to give us depreciation of that first machine? 800, very true, right? What will be the depreciation of the second machine? This 800, we simply say 10%, right? Multiplied by 8,000. What will be the depreciation for the second one? 1,000. No. 1,500. Remember, this will be 10%, right? Multiplied by how much? 10,000, right? Is that the end? No. That machine has been with us for how long? Has been with us for how long? From 1st July to that 1st December. How many months? 6 months out of 12. So that should give you what? How much should it give you? 500. Correct. We are learning. What about this other machine that we bought on 1st October? 1st October year 2000. What would be the depreciation? What will be the depreciation? What will be the depreciation? Very fast. We can respond 150. Maybe you are correct. So it will be 10%, right? And you see that? Multiplied by, what is the value? 6,000, right? You can see that. Then multiplied by, for how long has it been in operation? 1st October to that 1st December that year. How many months are those? 3. So 3 divided by 12, right? How much do you get? 150. True or false? True. Therefore, if we count that amount, the total there becomes what? 1450 for depreciation that year. And therefore, we come to the account for provision for depreciation. And in the P and L, or the profit and loss, we are going to debit it by that amount for that year, 1450, right? 1450, the one that you have calculated there. And therefore, you expect that our balancing there would be 2250, 2250, 2250, 2250. And that will be our balance in the coming year. Balance brought down to 2250, right? On 1st January 2000 and 1st January 2001. You look at the equipment, planted equipment, our balance carried down here is, we have all these equipments totaling to how much? 24. And therefore balance carried down in terms of equipment is 24,000, right? 24,000, that is the amount that we have at the end of year 2000. At the beginning of year 2001, that is the balance that this balance brought down is the balance that we bring down there, 24,000 in terms of the asset, right? That is the balance that we bring down there. Now, the next question, somebody is raising their hands. Just put your comment there. I'll be able to see it. The next thing that I want us to do is, in year 2001, did we acquire any machine? Did we acquire any machine? Very fast. Look at the information that you have. Year 2001, did we acquire any machine? Did we buy any machine? Year 2001, we did not buy any, right? Are you sure? Let me see. Year 2001, we did not buy until year 2002, right? And therefore here, I have year 2002. At what time did we buy the machine? You must always be very keen on time. 1st April, right? So we have an addition of machine 1st April, year 2002, that is when we bought. But remember, for the depreciation then, year 2001, we will still charge for depreciation. True or false? We will still charge for depreciation. We will still charge for depreciation. And therefore, balance brought forward is 2250. Someone is asking? No, Sawa, I get it. You're responding to the question. Look at the account for depreciation. We have year 2001, the opening balance is 2250, right? We have calculated these figures with you. What amount will we charge for depreciation that year, assuming now we have seen we never bought it in a machine in year 2001? It will be, depreciation will be for year 2001. What will be the depreciation, someone? I want you to think. Year 2001, what will be the depreciation? Not 225. You are Okumu, you are looking at this figure we have here. This is just a balance brought forward. Depreciation is on the value of the machines that we have that year, right? And therefore, Irungo Jemima, you are correct. That depreciation will be 10% multiplied by the value of the machines that we have. And as at year 2001, the amount that we had was still 24,000 in terms of the machinery, right? I hope you are able to see that. So multiply by 24,000 to get a value of 2,400. I hope that is clear. So here we have 2,400, right? And then we can close off that here because there is nothing else affecting it. Therefore, balance carried down here is 4650, right? And that is still the balancing figure there. So that at the beginning of year 2002, the balance in our depreciation account is 4650. I hope that is clear, right? Good. Then we go back. In year 2002, we added another machine. True or false? We added another machine. When did we buy it? 1st April, year 2002. This is January, sorry. So that 1st April is here. 1st April 2002. What was the value of the machine that we bought? What was the value of the machine that we added in year 2002? It was 2,000, right? The value of the machine was 2,000. And therefore, we can confidently say that at the end of year 2002, yeah, this one should be, the balance carried down, total asset was 26,000. True or false? It was 26,000. So what will be amount that we write in the, or we take to the P&L? What will be the amount that we take to the P&L? It will involve some calculation, right? We have an amount brought down of that, right? But we also have these items that were bought at this time, right? We have these items. Let me put them here for the workings. We have those items. We have, oh my, what has happened? I thought we copied this. Someone should have calculated that amount and given us the amount. We have those amounts there. Someone is saying 2,000. They are not responding to us. Good. So we have these items. right? We still have these items. And therefore, as at the end of this year, that amount is 20, is what was amounting to 24, right? And therefore, these items, because all of them are here with us, will be charged at what amount? 10%, right? And the 10% of that becomes what? 10% of that becomes what? 10% multiplied by 24,000. You get what? You will get 2,400, right? Those are for the machines so far. But there's another machine that we've added here. There's another machine that we have added here in year 2002 on 1st April, right? And therefore, here 2002, 1st April 2002, we have another machine, and that machine costed us 2,000, right? It costed us 2,000. So what will be the depreciation of that machine? Let me see what you people are saying. 24. What will be the depreciation of this machine? Someone find out. Can someone find out? Someone to find out. Someone to find out. 150. How did you calculate that? We have 10%, right? 10% multiplied by the value of the machine, which is 2,000. Then we multiply by what? We multiply by how many months did we utilize that machine? Good people. We bought it on 1st April. For how many months was it with us? 9. So multiply by 9 divided by 12. What is the amount that you get? What is the amount that you get? If you work out this, what is the amount that you get? 150. You get 150. And therefore, the total depreciation for year 2002 is supposed to be 2550. And that is the amount that you take to the profit and loss account here and write 2550, right? And therefore, you expect that the balance carried down here is 7,200. Is it correct? 7,200. So that the closing figures there, 7,200, 7,200. I want to hope that you are having an idea now of what is happening. You have an idea of what is happening. Do not let these accounts confuse you. This is a provision for depreciation. It is not depreciation account. It is a provision for depreciation. Depreciation account will only take this amount, right? The amount in the P&L. So that, for example, if you are to draw, let me delete this. If we were to draw a depreciation account, this is a provision for depreciation account. If we were to draw a depreciation account here, it should look something like this. Let me put this into perspective. It would look something like this, depreciation account. Here we have debited PL, we debit it here, right? And therefore in the depreciation account, we expect a credit of 800 for year what? 1999, right? 1999. That's the way it's supposed to be. Even oh my God, even calculation is a problem. From April to December. April is fast. So you count the month of April, May, June, July, August, September, October, November, and December. How many months? How many months? Yeah, people who are still struggling with that. How many months? Should be 9. It's 1st April. Yes, 1st April. Should be 9 months. That's why I say the time at which you buy is very, very important. If you had bought that machine on 30th April, it would have been 8 months. Do you see that? If you had bought it on 30th April, because would have now started counting in May, it would have been 9 months. I hope you are able to see that. It would have been 8 months if it was bought on 30th April. But now it was bought on 1st April, and therefore April is included. April is included. I hope that this is clear. Can we extract a balance sheet? Can we extract a balance sheet? We proceed and extract a balance sheet. Now, the non-current assets will be like this. The non-current assets will be like this. In 1999, the total cost of our equipment was 8,000. Do you see that? Do you see that? Because this is evident from here. Closing balance, right? The closing balance for 1999 was 8,000. What was the total depreciation for 1999? It was 800, right? And therefore here we'll say 800, right? You see that? What will be the net book value? 8,000 minus 800 to get what? 7,200. I hope it is making sense. Good. Year 2000. Year 2000, what will be the cost of the machine? What was the cost of the machines? Year 2000. Someone give us the cost of those machines, total cost of the machine. You look at the balances as a 31st December. Remember, we prepare a balance sheet as at the end. Good, 24. Who is this? Jemima. Here we have 24,000. And that 24, you can simply get it from here. Year 2000, the balance carried down, still 24,000. True or false? 24,000. And therefore, that will be, what will be the depreciation? Depreciation, you have it here. Year 2000, you are 1450. True or false? True or false? 1450. But because this is what we call accumulated depreciation, here it will be 1450 plus 800 to get 22. Accumulated means you've added the one for last year and the other year. You are adding it on top, right? So that you know the value, the total value of that asset, of the total asset. This is 21,750. That would be the value of our assets as at that point. Year 2000, the total value of our asset was still 24, right? But we have some further depreciation here of how much? Year 2001, we have an additional 2004 that is going to the P&L. And therefore, here it will be 24 plus the already one that is here to get what? 4650. Do you see that? So what will be the new book value? The net book value here? It will be 24,000 minus 4650 to get what? 19,350. I hope you are able to see that. I hope you are able to see that. Good. In year 2002, what was our closing balance again? It will be this 26 here. Can you see it? So this is our closing balance here for the total asset at cost, 26,000, because we have an additional machine at that we bought at 2,000. What will be the value of total depreciation here? The value of depreciation will be, what will be the value of depreciation? It will be the 4650 for this year. We add the depreciation for this year, which is 2250, as indicated here, right? To get what? 7,200. And therefore, at the end of year 2002, our assets are worth 26,000 minus 7,200 to get 18,800. To get 18,800. Good, very good. Now, if you get 2 or 3 students who are understanding this, I want you to appreciate this. even as we are doing these calculations, I am certain of this. There are some of you who are very fast in getting these concepts, like the ones now who are writing these answers here and contributing. For some of you, it is going to take time, right? It may not be as easy as it seems for us, and it is okay. You are not lost. It is okay not to understand immediately, right? Because we learn differently, right? Just the way some of you would want to like waking up in the morning at 5 to read. Others, that is not their thing. They would rather extend up to 12 or 1 at night and they'll be done. Others never even read. They only read during exam time. And therefore, the important thing here is understand yourself. How do you operate? Right? So that if you're not able to get it very quick in class, you must find a way of getting it when you are studying, right? You must find out a way of studying or looking at these things for you to be able to be on the same level with the rest of the students, right? And therefore, it is okay. You may not get it here for some of you. Some of you have already gotten the concept. They are giving us the answers, which is still okay, but we need to go an extra mile. Here we learn the concept, listen keenly, see what is being done. If you don't understand, you'll go through it. Again, if you don't understand, you'll have your friends to ask. If again you don't understand, you'll also have me to ask. I hope that is clear. I hope that is clear. What addition are we adding? What are the addition? There are no addition. Some of you are just getting confused. Let me insert a column here so that you know what I'm saying. What was the depreciation for 1999? It was 800, right? And therefore the total depreciation, this is not accumulated now. This is depreciation, right? There is difference between accumulated depreciation and depreciation. You must be able to note this. You are an accountant. You must be able to note this. For year 2000, what was the depreciation? You come to the example here. What was the depreciation for year 2000? It was 1450. True or false? So if you add 1450 here, what will be the new amount? What will be the accumulated? Accumulated means everything. Accumulated here will be that one for last year plus this one for this year, right? And that's where we are getting 2250. What was the depreciation for year 2001? It was 2400. True or false? So accumulated will be the ones that we have accumulated so far plus the one for this year to get what? 4650. True or false? Year 2002, what was the depreciation? It was 2250. True or false? 22 or 25, sorry. It's 2550, right? It is 2550. So what will be the accumulated depreciation? It will be 4650 plus 2250, which I expect to be 7200. Is that clear? Is it clear? Good people, is that clear? Do you want to digest this, or do we tackle the other one? There is another example there. Very hot one. We have another example there. Do you want to try it on your own? Do you want to try it on your own? Or do we tackle it here? Or should I give you 10, 20 minutes, you look at it on your own, then we tackle it? Let me not mix you up. Let me not mix you up, my friend. Who is this? Asking. Gitonga. Amani Gitonga Jacqueline. Let me not confuse you. For now, I don't want to introduce those many aspects. Do now. We tackle it now, then you digest all of them together. Nice. I like this. I like the spirit. I like the spirit. Good. So can you refer to the last example that you have there? Refer to that last example that you have. I think there were two examples, true or false? Delete this, that we do it together. Very good, very good. You have the question? Do you have the question? This one on the company depreciates its plant at the rate of 20% per annum. Straight line, right? Not reducing balance. Straight line method. From the following details, draw up plant account, the provision for depreciation account for each of the years. And again, this is not very different from the one that we have tackled, right? You just have to know in which year you did what, and then you'll be very good, right? So where do we start? Where do we start? Where do we start? I hope you're still able to see this. Are you? Are you able to see this screen? What I've shared? Someone to confirm? You're able to see the Excel? Yes, good. So if you look at that information that is in that account, simply, this is not very different from what we have done. You should have started now by populating all this, right? Not very different, right? In year 2005, January, what happened? What happened? Year 2005, January, what happened? Did we buy a machine? We bought a plant costing 900 on January 1st. True or false? And therefore, we record there 900. We record there 900. And you see that? In year 2000 and, sorry, this is 2005, we're still in 2000. In year 2005 again, on October 1st, we bought another plant. October, this one should be October 1st. Here we bought another machine. What was the cost of the machine? Can you give me the cost of that machine? Give me the cost of the machine. What was the cost of the machine? It is good you respond so that we move together. It was 600, right? 600 there, right? We record it there. So the total balance carried down in form of the plant was 1,500 for that year, right? Which is the total here. Which is the total there, 1,500, 1,500 there. We've closed that account, and if need be, we can bring this balance down in year 2006, right? 1st January 2006, that machine we have a total of 1,500. True or false? True. Then what happened in year 2000? And how do we account for depreciation in year 2005? Can someone calculate the depreciation? How much do we take to the profit and loss account as an expense? How much do we debit there? Someone? How much do we debit there? Someone to calculate. By now you should be able to calculate these things. What amount do we take to the P&L as our expense? Someone to give us a figure? 300? No. work harder. 180, no, work harder. Remember here we have two machines. Do you see that? All of them bought at different times. We have two machines bought at different times. Gitonga, you are right. 210 is the amount that we take to. How did we arrive at that? Simply, one machine was bought on January at 900, right? And therefore, the depreciation that we charge was 20% multiplied by the 900, right? Then we multiplied by 12 over 12, right? Because it was there for the whole year, right? What amount do you get? 180. True or false? The other machine, let us not be lazy. Accountant is not for lazy people. It's not for lazy people. The other machine costed us 600. So 20% multiplied by 600, right? And it was with us for how long in that year? We bought it on October 1st. How many months was it with us? How many months? 3 months. Do you see that? So here we have multiplied by 3 over 12. So what will be that? Someone to give us the figure? Someone give us the figure. Getting 30? Yes, 30, right? So that total will be 210, and it is the amount that we put there. And that will be the balance carried down, and it will be our opening balance in 1st January 2006. Do you see that? Good, 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 good. What happened in year 2006? Go back to the question. What happened in year 2006? Anything? Is there anything that happened in year 2006? There was nothing that happened in year 2006. And therefore, you expect that that balance in our plant account is the same balance that we closed it with on 31st December 2006. And therefore, we carried forward to 1st January 2007 as 1500. What was the amount of depreciation that we will charge for year 2006? Someone to give us depreciation for year 2006. Someone give us depreciation for year 2006. Someone give us depreciation for year 2006. Nirongo Jemaima and Malanga. That depreciation will be 300, right? And how do we get it? So far, we have equipment costing 1,500, right? Those were the equipment as at that 1st December 2006, and therefore 20% of that, and the time is 12 out of 12, because we have those two equipment for the whole year. Then we should be able to get the value of 300. So that is correct. So that becomes 510, 510, balance carried down 510, right? And the 510 will be a balance brought down on 1st January 2007, right? True or false? True, right? We go to year 2007. Go back to the question. What does it tell us in year 2007? That we bought what? Plant costing 550 on July 1st, right? And therefore, year 2007, on July 1st, 1st of July, 2007. We have bought a machine here. That machine has costed us 550. True or false? And is there anything that we have bought that year? Year 2007? Anything else? Nothing else, right? Nothing else. Good. And therefore, it means for that year, the balance was what? 2050? Is it? Is the balance 2050? And that will be our balance carried down for that year, which will form our balance brought down in 1st January, year 2008. It will be 2050 there, right? So what will be the depreciation for year 2008? What will be, no, sorry, for year 2007? What will be our depreciation for year 2007? Year 2007, what would be our depreciation? What would be our depreciation for year 2007? What will be our depreciation? Very fast, very fast. Why are you telling me 55? It cannot be 55. We also have other equipments. So far, up to 2007, right? We have two types of equipment. We have two that costed us 1,500, right? And we have others, or the one that we have bought in year 2007 that has costed us how much? 550. Is it 550? Right? The one that costed us 1,500, if we depreciated 20% times 1,500, what do we get? We get 300. True or false? True or false? For the other equipment that we were with at the beginning of the year. Then this equipment that has come in, we still apply the 20%, right? Multiply by the 550, but it has been with us for how long? For how long has it been with us? When did we buy it? We bought it on 1st July. So what period will we apply here? What period will we apply here? 6 months. Very true. So 6 over 12. And what do you get? 55. True or false? And therefore the depreciation for that year becomes 355. The total is at the end of the year is 865. Therefore balance carried down is 865. And that will be the balance on 1st January 2008. 865. 865. 865. Are we together? Up to that point, we must be. If we look at the plant account again, on 1st January, we have equipment costing us 2050, right? 2050. That is the cost of the equipment that we have as at that point. Did we add any other equipment in year 2008? Did we? We did not add. But did we sell? Did we sell? Yes. We must have sold. Now, if we sold, where do we record this item that we sold? Where do we record it? Where do we record it? Yes? I'm waiting for you. Someone to tell us where we record that. Someone to tell us where we record that. Someone tell us where we record that. I want to see what you're saying. When we sell on the credit side, when we sell an equipment, remember when we are buying, we are recording it on the debit side. True or false? And therefore, when we said we must be able to open another account we call plant disposal or asset disposal account, so that we come and record it here as an asset that was disposed. What was the value of the asset? 900. That is the amount at which we bought it, right? And that 900 is taken to this account we are calling disposal 900 to record that we no longer have that asset, right? Of course, we have not sold it for 900, but we have struck it out of our plant account because here we're only recording this amount, and therefore this is the amount. This is the equipment that we are selling. We must be able to subtract it. I hope that is clear. And because there is nothing else that happened, what will be our balance here in terms of the asset? What will be the balance there? Balancing will be 2050 here 2050, and therefore you expect the balancing figure on 31st December 2008 was how much? What was the balance? It was the balancing figure here is 1150. Can you see that? So that we get a total of 2000. 1150, very good. For those people who are able to confirm. But we are not through with the depreciation for that year. We are not through with the depreciation for this year. So how do we get the depreciation for that year? Who can calculate the depreciation for that year for us? Depreciation for year 2008. What was the amount of depreciation for year 2008? What was the amount? What was the amount? What was the amount? Someone to try it out. Someone try it out. People are still trying. Someone give us the figure. You already know the items that we have. You should be able to calculate. You should be able to calculate, bearing in mind that that item was sold at what time. So for how long were we with it? How long did we have that equipment that was sold in year 2008? How long did we have it? Someone is getting 535. 535 is a good trial, but no. 535 is a good trial, but no. Someone is getting 365. 365 is a good trial, and it is correct. 365 is a good calculation, which is correct, right? The answer is not 307. You have not factored in something, Irongo Jemima. You've not factored in something. And therefore, if you look carefully on these other calculations that you are doing here, you will find that in year 2000, akupigia makofi Gituro. Gituro, hii leakage ulipata wapi bwana? You logged into my computer now that you're learning computer science. My friend, kuja pole pole. But makofi kwako. You've done a good thing. You've understood the technicalities. And they are not many. Just knowing what equipment did we have? Did we have it for the full year? Or was it just for a part of the year? And therefore, if I look at year 2008, right? One, there was an equipment that we sold on 30th September year 2008. What was the cost of that equipment? It was 900. True or false? True or false? And therefore, the depreciation expected here would be 20%, right? Multiplied by 900, right? Then multiplied by how many months? How many months did we have that equipment with us? How many months? How many months did we have the equipment with us? 9. Good. So 9 divided by 12. What do you get? What is the amount that you get? What is the amount that you get there? 135. True or false? 135. True or false? Good. What other item did we have? What other item did we have? Do you remember we still have a machine that costed 550? Do we? Do we have a machine that costed 550? And therefore we charge depreciation 20%, right? Sorry. Multiplied by 550, and we had that machine for the whole of the year, 12 over 12. What amount do we get? 110. True or false? We get 110. Oh my, at hiyo 9 months imetoka wapi? We are, my dear, who? What is the last information that you have here? In year 2008, what have you been told? That we sold a plant that we bought at 9, that we had bought on January 1st, but we sold it on September 30th, 2008. So for the whole of 2008, we had that machine for only 9 months. We had the machine for only 9 months. And therefore, those are the only months we are accounting for depreciation for that machine, right? Because that is the only the period that we had it into the year 2008. So that's where 9 months are coming in. So we have 110. Then we have another machine still with us that costed us how much? 600. Can you remember that? And then we charge depreciation at 20%, right? Multiply by 600. For how long did we have that machine in year 2008? For 12 months, the whole year. So this we get what? 120. Therefore, if you add this, what do you get? 365. And therefore, that is the figure first that you bring here to the P&L, 365, so that your closing balance here becomes what? 1230. Is it? Balance carried down to be 1230 here. $12.30. Good. Good. 12.30. And therefore, what is it that we have not done? We are not through with the disposal account, right? And you remember that? In accounting, you must be sharp. Don't forget things. They must always be at the back of your mind that I'm not through with this, I am not through with this, right? Remember, we have sold a machine. We've only removed it from our plant or from our plant account and opened a disposal account, right? We opened a disposal account. What is the provision for depreciation? Or what amount did we receive in short? What amount did we receive for that disposal? What amount did we receive? Very fast. We sold a machine for how much? How much were we given? 275. And therefore, that 275 is credited in the plant disposal account and debited where? Where do we debit it? Where do we debit that amount? In the cash book, right? Debit the cash book because we have received credit disposal account. But now we are not required to prepare a cash book. That's why we only dealing with this one other side, because it is not a requirement here that we prepare every account that is affected. We're supposed to only prepare this account that we've been asked to prepare. And therefore, is a debit of that. So what will be the accumulated depreciation here? What will be the accumulated depreciation? So far, it will be the balancing figure, right? Which is 675. 675. And if you want to confirm, you can still confirm that figure. It should add up to that. It should add up to that. Good. Extract of a balance sheet. Extract of a balance sheet. And then we are through. How do we extract balance sheet? 1999. What was the amount? 625, eh? Sorry. 625 to get that. Thank you for correction, eh? Thank you, Getonga and the company. Satika bwana. Hey, my friend, you are this sharp. Atika. Keep it up, eh? You are my eyes. You see that? I'm glad. I am very glad, eh? Good. So we populate this other thing, this other accounting, the balance sheet extract, or how the this will be accounted on our balance sheet. So 1999 cost, very fast. 1999, oh, sorry, this is the different. This is 2005, 2006, 2007, and 2008. Again, thank you, Wanyama. Kutuma ujumbe kwa Wanyama. Good. So what was the cost? 2005. Someone give us the cost of the equipment that we had in year 2005. Someone to give us the cost of the equipment. Come on. What was the amount as at the end of year 2005? Just look at the plant account. Look at the plant account. What was the amount as at the end? What was the amount is at the end of year 2005? Look at the plant account. You should be able to know the balance carried down. These things don't require reasoning. You don't require reasoning. You just look at it, populate it. What was the total depreciation? If you have calculated it the way you have done here, it should be 210, right? 210. Net book value should be 1500 minus 210 to get 1290. True or false? 2006, what was the value of the plant? Still 1500, right? The total depreciation we have accumulated, eh? So 210 plus 300 to get what? 510. 510. The new book value becomes 990. True or false? Good. Year 2007. Year 2007, what was the value of the equipment that we had? The value of the equipment that we had at cost? Very fast. Look at those figures where they are. These are straightforward things. You don't waste a lot of time on them. They don't require you to think. 2050. Thank you. What was the accumulated depreciation? 510 plus 865. No, 510 plus 510 plus 355. Can you see that? So 865. What is the value? Net book value? Net book value? Net book value 1185. Thank you. Year 2008. What was the value of equipment? Year 2008. What did we close with? Year 2008. What did we close the year with? 2050? Really? No. Look at the balance carried down for year 2008. Musundi and Nzomo. Look at those balance. Yeah, 2008, what was the balance carried down from the plant account? We have it here, my friends. Can you see this? Since they are here, you just populate them. Some of you are thinking this is coming from the moon. I'm around. I've not gone to the moon. So what would be the accumulated depreciation? Accumulated depreciation there? Someone? Someone to give us accumulated depreciation? So that we are through with this? 1230? No. Rogers and Zomo? No. Purity, pure purity. Puree? No. Nzomo? Rogers? No. I know you are on track. You've not finished the calculation. Remember, we have disposed a machine. And this is whatever you are giving us is the accumulated depreciation for all the machines. It's the accumulated depreciation for all the machine. There is a machine that we have disposed, right? So what is the total of accumulated depreciation for this year? 365, no. 365, no. 330, no. Oh my. What is the total accumulated depreciation? What is the total accumulated depreciation? Is it 1230? It is 1230, right? And what is the accumulated depreciation of the machine that we have sold? What is the accumulated depreciation of the machine that we have sold? Because we must be able to subtract it from here. What is the total? Oh my. You're getting tired now. 188, 65, 355, 1095, 330. Oh, hata unashangaa hizi figures zinatoka wapi? My friends, I'm asking in a very simple question. The total accumulated depreciation, which is in the provision for depreciation, the total is 1230, right? 1230. But we have sold a machine, and that machine had an amount of 625 in the account for provision for depreciation. So what is the net balance that we have carried forward? What is the net balance that we've carried forward? It's coming to 605. Is it 605? Or should we calculate 625 imetoka? What do you mean, Lillian? 625, 605. I am very interested to know about this machine. This machine is very, very interesting. Someone is even asking where you have gotten 625 from. This is quite interesting. Very interesting. Now look at this. Look at this calculation for depreciation, so that we extract the depreciation for this machine. Can we calculate the depreciation for this machine? This machine, 900, to give us 180 there, right? 180. Then we have the other time is here, still to give us another 180, true or false? For that machine, this specific machine whose total is still there, we give it 180 or 100 and yes, 180. Then here, still have that figure there to give us another 180, right? And then we have another figure here wherein it was disposed, a depreciation of 135. True or false? Can we trace that machine that way? Yes? Can you trace that machine that way? Can we trace that machine that way? Is it clear? Is it clear? Because you need to take that machine and calculate it this way. That the first year, 900, the depreciation was 180. The second year, the 900 is among this, right? And this for the whole year, depreciation will still be 180. That year, 2007, that machine is still with us. The portion of it still a full year, 180, right? But the final year, we are selling it, but we have disposed it. But the depreciation for 9 months is 135, and therefore, adding this, you get a total of 675. What have I done? Adding that, you get a total of 675. So I ask again. I ask again. And I ask again, what will be the value of depreciation there? The value of depreciation, total depreciation will be 1230 minus what? 1230 minus 675. What do you get? Thank you. 555. If we less that, we know the net book value is 595. True or false? Yes, that amount. It will be that amount. It will be that amount. It will be that amount. Now, I want you to look at this figure here closely. I want you to look at this figure here closely because I want to introduce one more thing. I want to introduce one more thing so that you don't get confused. Because whatever we put here, insert to push cells down. What we have put here is the total difference as a balancing figure. When in fact, what we are supposed to do, we were supposed to differentiate it. Calculate the depreciation this way, right? Come and write our figure here as 675, right? The total of this will be 950, right? The 950 becomes our balancing figure down here. You see this clear that we have 950 there, right? My, this is coming from. My friends, are you able to see this? It becomes 950. Because we have a provision for depreciation, this is the amount. We have realized 675. This has become 950, and therefore we have some amount that we need to put there. We have some amount that you need to put there for it to balance. Who can tell us what we can call that amount? Who can tell us what we can call that amount? Is it a gain on disposal or is it a loss on disposal? Is it a gain or a loss on disposal? Very fast. That is the final thing that I'm going to deal with today. Is it a gain or a disposal or a loss on disposal? Someone? Gain or a loss? This is a what? A gain on disposal. A gain on disposal of machinery. And this gain on disposal, we will debit the account here and take it to P and L as a credit that should be added to gross profit. It is an extra income that we have gained on disposing this machine, and therefore we debit it here, right? The way we have put it here. But then the alternating account, remember double entry? The alternating account should be the P and the L on the credit side. We record it there as a gain on disposal of an asset, and we add it to gross profit. I wish to put a full stop there. I am putting a full stop there. I want to hope that what we have covered is well understood, right? I want to hope that what we have covered here is well understood. And if it is not well understood, it is not cast on stone. I don't expect, in fact, let me shock you. I don't expect you to understand this now. But for those people who have gotten it right, you people are sharp, right? I expect to practice with the 2 or 3 others, probably after going through what I will be posting, practice with 2 or 3 others, examples, and then from there, you should be able to crack it anytime it comes, right? You should be able to crack it anytime it comes. Is there a quick question that I need to answer? Meanwhile, I also need to enable some feature here so that you're able to mark the register, if you don't mind. Right? You are good people. Good people. Uhuru amefungua. Unarudi shule? It's beyond us, eh? It's beyond us. Let me set it up here so that you tick again for me today. And again, last week, I know there are who I told to tick, and they never ticked. And if we look at these things, I hope you are told that if you fail to attend, is it 75% of your classes? 75% of your classes. If you fail to attend 75% of the lessons that we have here in financial accounting, even if you get an A, we'll assume that you are not in school. You get a 0, a fail, right? So it is important. Your attendance is as important as anything else. Yes, the illustrations must be in the notes. And all those workings that we have done will be there in the notes, right? Yeah. So let me enable you to mark the register, and it must be marked in the next how many minutes? The next 10 minutes, right? The next 10 minutes. Let me enable you. The next 10 minutes, you should be able to mark. It is good. It is okay now. You can mark in the next 10 minutes. Otherwise, thank you for availing yourself. I know this sometimes these things we are doing here are a bit difficult, right? But this appreciate that this is another level of learning. Appreciate that this is another level of learning. Was it important, necessary to retrieve the other amounts of depreciation when dealing with the last item of 2008? Why could we not do like the rest. I am not getting that question. Speaking truthfully, I'm not getting what you say. For year 2008, how this way the what we have worked here or what? Is it what we have worked here? All these for all the years are here. It's only that I was working on them here, then transferring them here. Because now you need these workings. You know, it looks more neat when your workings are done in a sober way. No, for year 2000, so that in time you want to get that figure, you get it. It's only that I was doing it here so that you are able still to see what we have on this. But I would prefer if you're able to set aside a space where you can calculate for year 2005, get the total, year 2006, get the total. Because if you realize these are the figures we are struggling to count here to be able to get this. So it is necessary. It's necessary that you do it this way. This is accounting, eh? It is necessary that you do it this way. This would be under your workings, right? They will be under your working. But what we are saying, how you calculate them, whether you put them here or not, is a different story, right? As long as if I find a figure of, let's say, if I find a figure of 210 here, I need to know where it has come from, right? And therefore, I expect, even if you put it this figure P&L 2000, don't assume I know what this means. You must show me where you have worked to get that 210. So this is still important. It is still important. I hope that is okay. Gitonga. Or have you submitted that assignment? Have you? I hope you've attached it, because I will use it to grade you. It will contribute to what you get in your exam, right? But otherwise, I will not have any issue going through it. If you remind me next week, yeah. If you remind me next week, I should be able to go through it. It's not a big deal, because I don't want to go through it today. I don't want to mix up things. Alternatively, I can still send it to you when it is done, it's dusted, so that you know where you went wrong, right? Thank you, Amboy. Always a pleasure. It's always a pleasure. Mwangi, consult your people. Why is this not at the Ioneshi submit? You saying at the Ioneshi submit? Kwani ni yako peke yako? Have others marked? Have others marked the register? Have others marked the register? Yes. So can you ask these people what they are doing that you're not able to do? Thank you all. Thank you all for your patience, for your attendance, for your encouragement, yeah, and for being there for me. You know, it would have been very different if I was talking to myself, right? Yeah, but you're here with me through thick and thin. When you're understanding, when you're not understanding, when I am too fast, when I am too slow, you're here with us and with me. And for that, I'm very grateful. For that, I am very grateful. If you never submitted your assignment, you're looking for zeros. I admire how hard you are working to get them. Eh? I admire how hard you're working to get your zeros. Because this is an institution of higher learning. When you're told that the assignment must be submitted by a certain time, it must be submitted. And for you to learn that lesson, I think the best thing is if you get a zero now, next time you will be keen to ensure that you submit it in time. Thank you, Pauline Wangeshi. Thank you, and karibu Kadhaya. Odhiambo, Jangmin, karibu sana. Kitonga Alexander, karibu sana. Onesimus Wambua, karibu sana. It is always a pleasure. Vivis Mwangi, karibu sana. Yeah, you can leave the Rogers, you can. The lesson is done and dusted. You can leave at your own pleasure. It was nice. Nice, nice, nice. It was nice. Good day too. I wish you all the best. Ensure to revise. The exams are not very far away. Ensure that you revise your work and that you consult your friends, right? Yeah, ensure that you do that. It will make your work easier when it comes to the exams. Sawa sawa. Questions on what? Is this? Who is that? Is asking for questions? Practice. I can send. I can send. I can send, but I always send you extra questions. True or false? So I always send you extra questions. I always send you extra questions to do that. I always send you extra questions. Duncan, I have given so many things. Assignment, cards. You should not worry. Kama kuna moja ilipotea. You should get a makeup, or we should be able to issue another card later on as you revise. I'll be giving another makeup, a more comprehensive makeup for any person who could have missed one or another. Told you, my people, you can't fail. And if you fail, it is because you have decided to. It's because you have decided to fail. Otherwise, I'll be giving makeup later. Right? Once we are through with all this. Thank you. Thank you, Irongo. Is it Jemima? Irongo Jemima. Thank you. Ian Kipkorir, asante sana. Asante sana. I appreciate. Thank you, Givan. Is it Givan Charo? Givan Charo Kazungu. Appreciated. Enjoy your evening. So if there's nothing else, let's have a beautiful evening and take care. Thank you.